Hey, Brent, thank you so much. I know it has been back and forth, and I've been trying to get you for quite some time. I know schedules are crazy as Web3, 24 hours we are working. There is no time zone limitations. But, this podcast that we have been hosting is mostly the previous ones were more about the market, crypto, Bitcoin, what's happening. And now being a builder and a founder myself in this, not so sure whether we call it as a bear market or bull market or whatever it is. It's very important for founders to understand what VCs and investors are looking for, and having you will be perfect for a lot of founders like me, and understand if you are building in this market, what it looks like, what you should be caring about, how you should plan. So thank you so much for joining me today, and I am looking forward to an amazing detailed insights from your side.
Absolutely, yeah. And thank you for having me. And I believe in the expression persistence beats resistance, especially when it comes to fundraising or getting people on podcasts. It is leveraged in multiple verticals in life. And yeah, I'm the same. We have some big announcements, Toby and I, coming up very soon, and running events, launching a venture fund, all these like different things. And so I will be feeling your pain very soon on how all that goes. So yeah, thank you for having me. And yeah, it has been let's just say, I think everyone in Web3 would say that this year has been a roller coaster of a year, right? I would say from last year was definitely a bear market. Then the beginning of this year, Q1, Q2, a lot of tokens were launched. There's a lot of hope in the market. Q3 has been a bloodbath for token launches. I think every VC looks at their portfolio and they were hoping that a lot of these tokens that were launched in the last 2 quarters would revive a lot of their portfolios. And unfortunately, it has been the opposite. And I think a big part of that, the interest rates in America, that has been very wishy-washy. They're going to go up, they're going to go down, they're going to stabilize. And then, of course, the U.S. elections coming up, which, for good and for worse in our country, we have only two parties that basically run. And one party, as we know, seems to be, at least, because as we know, politicians say one thing and do another thing, but one party seems to be more pro crypto, one doesn't. And so there's a lot of investors, a lot of family offices, a lot of LPs that are kind of holding their wallets, so to speak, to kind of wait and see what happens. So all that means is, fundraising, token launches has been very choppy the last 6 or 7 months now.
Absolutely. And, we all are looking up to it, especially the last night debate. I was looking forward to it, what's happening, who is getting, more likes, because that would a lot of things, what will happen from now till November in the market will reflect how the election marketing and sentiments goes either this way or that way. But Brent, understand, US interest rates are there, also understand how the market has been fluctuating. But as a VC or funding to different startups, what are the challenges that are you guys seeing? I was talking to another, VC fund, Sagar from BFC, and he was saying a lot of good projects. It's difficult to find now. A lot of good projects, like finding a good deal is also a challenge. So, would like to understand from your perspective, are you guys also facing the same thing? What are you seeing the founders are building, and why do you think, if it is the same case for you also, not finding good deals or finding great deals, what is the main undercurrent reason behind that?
How long do we have? No, I'm kidding. Yeah, it is.
You can keep talking as much as you want.
Yeah, no, it really is a very good question. And Sagar shot in. I'm a big fan of BFC and what they're doing. Yeah, it is. Look, I think in the Web3 space, right, we've had a lot of cycles. A lot of people made money through crypto investments, through tokens. And I think when the interest rates shifted majorly from basically ZERP to where they are now, I don't think a lot of people really pivoted to the new reality, which is if you're not building something that brings utility and value to the world in the Web3 space, then you're not going to get anywhere. And I think just there's a lot of ICOs, a lot of meme coins and things like that went hyperbolic and then went cratered back down to earth. People made some money, people lost some money. And those days are long gone, right? The days of I'm gonna launch token, I'm gonna 100x, I'm gonna dip out, rug everybody. Those are gone, right? So what that means for VCs is all right, well, what are the themes? What are the verticals that are actually producing companies that actually generate real companies that actually can be sustainable? And what I like to look for, especially the last year, is companies that are raising equity plus a token warrant, meaning they may launch token in the future, but it's not the core focus of the business. And I can tell you that's a very different mindset compared to a founder that's raising solely a token, right? Because where the incentives are aligned. I've said this a lot through my content and a lot of deals I do, but I call it kind of Web 2.5, which is not a new term, right? This has been around for a while, but I'm seeing a reemergence of this where And how I just define that is basically just companies that are targeting Web2 users. Very simply, could be businesses, could be users. It's just, I think there's been so much selling back and forth in the Web3 space the last 10 years now, where it's like everyone's just selling to each other versus like, if we're actually going to like bring crypto and Web3 to the masses, you have to make it easy for onboarding to people like our parents, grandparents, teachers, like anyone that's like not in the kind of Web3 space. Like, oh, how can I onboard easily? And so those are the investments that I've been making, and I've seen that those companies are generating revenue. They're getting to $1 million+ ARR. However, those companies have a different challenge, which is they go, look, we have a real company, we have a real business, meaning we produce revenue, we have metrics, we have CAC, we have just like a traditional, AI investment or consumer bet, right? Software bet. However, when they go to raise, they go, Web3 VCs don't want to invest. They're not interested in what I'm doing. And I'm like, why? They're like, well, they always ask, when's my token launching? Am I launching a token? Right. And this is the kind of weird cycle that we're in right now, which is, in the venture space, especially in Web3, when you compare like Web3, like venture funds, fundraising compared to AI, it's like not even close. We're talking like 100 to 1 as far as money, developers, everything as far as like interest goes. And so in our kind of small space, there has been, again, a lot of VCs that made money from cryptocurrencies launched a fund, raised a lot of money during these kind of hyperbolic periods of like low interest rates where tokens were launched easily. And now they're looking at their portfolios and they're a mess because, again, these tokens are not going well. They're looking for any angle to kind of get short-term time horizon investments to then save their portfolios. And so they might look at a deal that is very good and has real revenue, but when they look at their portfolio, and look, VCs are just like founders, right? We're only as good as our last fund. And especially in the emerging manager space where essentially you're a fund under fund 3, you won't get to a fund 3 or 4 or 5 if you can't get past your first 2 funds and you need to produce returns. And so that pressure puts pressure on founders by basically saying, look, yeah, you have a business model, you have a revenue, you have customers, but you don't have a token, it's launching soon, it's not as interesting. And then they see their friends or someone else raising on a token, they raise it easily, then the token flops. But again, from an investor perspective, if you have a short-term time horizon, you have a 2-year time horizon, so you need to raise for the next fund, you need to get your numbers up. It's just human nature. They're going to take a bet on the short-term play versus the long-term play.
Yeah. I mean, I've been in this boat. So, when we started Solus, we were same model. We are still same model, equity plus token, right? But then when I completed the first round and then was going for the next round, a lot of VCs, and I will say like the small VCs, not the bigger ones who are looking for a longer play, but a lot of VCs and angels are like, okay, when are you doing your token launch? So they literally do not care what product you are building. Like, I was surprised in some of my meetings, no one asked me, how good is your product, how many users you have, what is your revenue. People were just asking me like, okay, give me your tokenomics, how much unlocking will I get, when are you doing token launch? And there was some conversation, how many Twitter followers you have. I was like, you guys are crazy. So I think what's happening here is, luckily I didn't end up raising money from any of those because I was not going to commit to people like when I'm doing the token launch. Token launch can only be successful, as per me, is when you have a running product, good revenue, you have a user stickiness, then users will use your token. Otherwise, it is just a pump and dump, right? But yeah, I mean, I totally agree with you. Whoever other founders are telling you this, I have experienced that myself too. So, and maybe that's costing the industry maybe overall, because there is one philosophy which I would love to know your perspective is, people are doing token launch or ICOs or IDOs, whatever it is, before they even have a product or even they hit midnight. So they are doing these ICOs to raise funds through which they will build their product and they will go live. What do you think about this? Because, if you go to traditional Web2, because I come from a Web2 background than a Web3, like, it's more like you will do an IPO or something when you are much more stable, when you have enough, users, you are doing good traction. But once the ICO is done upfront and then founders get the money, what is the motivation of the founder, unless they are really serious about the business, to actually carry over and deliver value to the investors? Like, what is your take on this process? Because it will be very interesting to understand from your perspective.
You mean like, what is the motivation from an investor perspective to invest in a company that's already launched a token?
No, I mean, like, there are founders who are doing ICOs just on paper, and there is no product, there is not even testnet. They're doing ICOs, and then with that money, they are committing that we'll build something XYZ, and then building is never happening, right? What do you think about this kind of scenario? Like,
okay, I understand now. Yeah, it's there's an expression when it comes to raising money is it's easier to raise money with a dream than metrics.
Yeah.
Right. Now that is taken to the nth degree in the crypto space by basically saying we're not going to build anything, we haven't built anything, and we're just going to raise on a dream because again, you don't have to show anything. You don't have to. The moment you launch a product, you are judged, and that's another big fundraising mistake a lot of founders make is, well, I'm going to launch my product first, then I'm going to try to get customers, and then I'm going to raise. Right now, there's nothing wrong with launching a product in you should from day one already be talking to customers and like understanding and iterating over and over and over again. But the idea of like, I'm going to use all my runway up, launch my product, and then raise is like a very dangerous proposition because again, you're going to be judged very harshly on what's your month over month growth, like what's the stickiness of the product, right? You may iterate, may take you a little while then to like get things correct to get some more product market fit, and then you can actually raise. So for a lot of founders, there's this kind of gap of like, all right, do I just raise money before I have anything, or do I actually launch a product and then iterate for like 6 to 12 months and then try to raise again? And that's again like a big thing, like first time founders, especially in the first funding round, like really understanding that process and thinking however long it's going to take you to raise, like double that, and then that's what you make your runway off of. So if you're like, okay, I have 6 months of savings and I got this 50K grant from this layer one, and that means I have 11 months. It's like, no, you probably actually only have 5 months of runway because there will be issues, there will be problems, there's going to be and so yeah, that's where and then if you're raising from a sign of desperation, right? Like no one wants to invest in a deal that feels desperate. We're like, oh, I only have 1 month of runway, right? Then you kind of go into this virtuous cycle of negativity, which could all have like stopped it from the beginning. You were like, okay, here's what I'm going to set out to do from the beginning. Like, am I going to be someone that's going to raise basically without anything, or am I going to be someone that's going to raise after I've launched a product and like I've had a chance to iterate with customers over and over again? And if you're anywhere in the middle of that, you're screwed. But if you stick to either one of those two sides, you have a really good chance.
Interesting. So I mean, I understand like selling on dreams is way easier than actually proving out the product. But what is the balance looks like here? The reason I'm pressing on this is like, a lot of these founders are actually launching ICOs and then there is no product. And that might be also creating a bad impression on the industry and investors losing money. What do you think about that? Like, are you guys also coming up on projects like that where it's just ICOs and then vanish?
I mean, we've seen a lot of it. We haven't invested in anything like that in recent memory. I mean, at this point, if you're doing like ICOs and you're not launching a product, I mean, it's pretty obvious like what's going on. I mean, right? I mean, this is, and this is what I'm saying, right? Like, there's pressure. There's investors that are looking for short-term time horizon investments, right? They don't care if it's good or bad for the industry. They're just like, it's human nature. My fund, I need to raise another fund. I need to show performance. If this founder thinks he can 10x my investment in this short-term window, then they're gonna invest in that company over a company that has real revenue or that's building a real business, because again, for that investor, it may be able to help their portfolio. And that's like the next level of thinking with founders, that whenever I make an investment or we look to work with companies on the advisory side, have you ever raised capital? If so, how many rounds have you raised? Because these are things you like pick up on, especially with like when you're interviewing a VC. How many funds are you on? Which fund are you on? How far into deployment are you? And when you ask a lot of these like DD questions on funds, it's not surprising. The answers you'll get are not going to be surprising when they're asking you these questions. If they're solely focused on your token, there's a reason, right? They're like, oh, our fund's 80% deployed and we're going to be raising another fund soon, and they're only focused on your token. Well, I wonder why.
Yeah. Okay. Well, so also going back to your answer, right? When you were answering on the first question, is like we need to build something where our father, mother, grandfather should understand, right? Like this is the product coming in. That means in Web3, it's high time that we build the product that's bringing utility. This brings me to a question: centralization versus decentralization, right? Fundamentally, being in the industry, I understand why decentralization is important, what value it brings. But majority people do not understand what is decentralization. Especially also the user onboarding, UX issues, and all the things are anyway hurdle. So what is your take on that? How do you think my blank question is how far we are from actual mass adoption, or at least a better adoption of decentralization compared to centralization? Are we very far, like 7-8 years? Are we close enough? It's just there and going to happen soon. What is your take on that?
I mean, I would love to have a crystal ball on the exact time frame for that, but all I can say on this topic is what I what I try to invest in, which is companies that are primarily targeting Web2 users to bring them to Web3. Like I like companies where when I see their demo, you wouldn't know if it's a Web3 company. And a lot of the like Web2 investments that we've done, if you looked at their pitch deck, you wouldn't even really know it's a Web3 company. Like from their materials, from their presentation. And then the debate on centralization versus decentralization. I mean, I think if you're in crypto, right, like you understand the point of like decentralization. And I would say from a political perspective, like most people in crypto are probably more libertarian, right? Of don't like centralization, don't like central authority, want to own my own stuff, don't want people spying on me, all that. But does the mass population care about that? And I think it's been a pretty resounding no. When you think about all the major tech companies and how much data people give up, do people really care? I mean, I try to, it's very hard with human biases, but I try to, as best I can, not put my personal bias on a deal or a company. If you know, logically I can, subconsciously it's another story. But yeah, because if you really look at it, it's like, well, Apple, I mean, takes all of our data. They've been dominating the App Store forever. They've been running a monopoly. They are a very centralized organization. They have everyone's data for everything, and like no one complains about that. No one says, "So Apple has all of our health data, our hearing data from the AirPods." Like they have like everything on us, but like no one's like running pickup polls at Apple saying, "I want my data." So that's like another thing in Web3 that about like real use cases. And when companies go, "Oh, well, we're gonna make it permissionless, and we're gonna make this decentralized," and it's like, why? Like who cares? Who is your target? If your target market is people in crypto, like, oh, okay, but like this is to your question about the masses. Like I don't think it's a big needle mover.
Yeah. So you also mentioned like, when you guys invest, you in the pitch deck, you cannot tell whether this is a Web2 or Web3. Can you elaborate on that? Is it like the pitch deck is not talking about what technology, and it's more talking about what's the problem, what's the target user? Like what does that sentence mean, if you can elaborate a little bit on that?
Yeah, it essentially just means that they may mention blockchain or they may mention crypto on the like deck, but and this is like another thing that happens a lot with founders at early stages is they get and this is a whole other topic I could go down a rabbit hole on, but when you build a team, right? It's very rare on planet Earth that there's someone that is so gifted on the tech side and is also amazing salesperson / people leader, right? It happens. We've seen it, right? Like there's Elon Musk of the world, there's like those type of people, but like it's very rare. So meaning on a founding team, you divvy up like skill sets, and yeah, when you're presenting the story, it's like, does the investor care what the product is? And that's what's really interesting is these Web 2.5 companies that target Web 2 users, and you look at their cap tables, they have Web 2 VCs, they have Web 3 VCs, and they say, I talked to Web 3 VC, and he asked me, well, which chain am I building on? And like, why am I an Avalanche versus Bear chain versus this or that? And then when I tell them which one I'm thinking about, then they judge me on that, and they say, oh, it's a horrible idea. And then he's like, this has nothing to do with like my core business. Like what this is actually going to accomplish, we can change like, and then he talks to a Web 2 fund and they don't even really care about it. They're just like, okay, if you're going to use blockchain versus AWS because it saves you money, it's faster, it has all these other benefits, great. And it works, great. Right? Because they're thinking about it more from just like, does this business, and this is like when I work with founders about like, what is the branding? What is the presentation of your company? Like if you're in that middle space of Web 2 or Web 3, you should definitely change your whole narrative away from Web 3, because the amount of investors in Web 2 that would look at your company from a consumer, fintech, angle, I mean, B2B angle, I mean, there's just significantly more investors, and you have a much better chance of raising. And that's like the other thing is like a lot of founders first time run their heads into a wall because they're like, I'm a Web3 company, I'm talking to Web3 VCs, and they don't want to invest because I'm not launching a token, or they're complaining about different parts of my product based on just what chain I'm building on versus like the actual meat and potatoes of like what they're actually building.
Absolutely. So when we look into the Web3 ecosystem in terms of like investment and all, there's a heavy investment that has went into infrastructure, and then a lot of Web3 VCs they prefer to invest in more infra than compared to user-based things. So from your perspective, like the VCs, two questions on that. What is your take on that? Are you biased more towards infra, or you are like, no, let's build something which is more user solving? And the next is, what is the thesis of your fund? Are you guys funding both, or you guys are inclined to one then other? The two questions on that.
Yeah, those are two very good questions. I think if you ask any investor what they invest in, and then you look at their portfolio, I think you would find a lot of different answers. So I never like to be like, we only invest in this, because you also have to be open-minded mentally on like, okay, well, this is an interesting infrastructure play, but we haven't done as many deals in this space. Like I still want to have a shot at that. But yeah, like I'm myself and Toby kind of split up different interests in our fund. I mean, you can't as a VC, you're a master. You know a lot of things, but you're a master of none, right? Like it's not possible for us to know the latest technology on DeepIn and every different ecosystem, and on top of running a company, all these things, right? So you have to pick kind of themes you're interested in that overlap these different smaller themes. I'm much more consumer business friendly. I come from the web2 space, so much more traditional business models. The other part of our fund, we look at token investments, infrastructure plays. So we made investments in companies at our prior fund, like at Berachain. We made an investment in BitLayer recently, Bitcoin ecosystem play in Southeast Asia. We've done quite a wide variety of investments, but we primarily focus on North America and Southeast Asia. And we are, with our new fund, we'll be investing again North America, Southeast Asia, but we'll be leading in co-leading rounds. So we'll be doing less investments, higher checks with more conviction, with companies either in those regions or looking to expand into those regions. And so that will be like a $500K to $2 million ticket into those kind of companies.
Understood. And what is the stage of these companies? Like early stage, revenue generating? What is the stage, or you guys are pretty much open?
We're pretty open. I think it's more from a valuation perspective, we're looking for companies if it's on an equity or equity plus token under 30 million. If it's token only, right, that can be more flexible. But it's more about how many funding rounds you've had. So if this is your first round and you've not raised any money, like we're definitely interested. But as a potential lead for your round, like we want to see, can you get smaller checks, right? And this is like a whole debate in the founder community about, hey, I just need an investor and I need a lead. And then when I go talk to other VCs, they say, we'll come in once you get a lead. And then they talk to the lead, and the lead goes, well, you got to get other investors, and then we'll come lead. And the founders are like, what the hell? Why am I getting different answers? And the reality is, as a lead now, you have to do kind of both, meaning you still need to be having conversations with leads, but easy things to do is and one thing I always look for is angel investors, right? Before you ask for $1 million check, can you get someone to give you a 25K check or 50K check? And if you come to me and say, I can't raise any money, but then I want you to invest $500,000 into my company, I'm like, now from an investor to a founder perspective, does that make sense? Because it doesn't make sense. And that's again, part of I have a whole thing on how to build your network of investors and what stage you are with that. And if you're starting from ground zero, you have to go to conferences, you have to, and this is a whole nother topic, right? If you're going to build a network of investors and you're trying to raise a round, it's you either have to build it through in-person events, which we all know the people that myself included, that go to every single conference, and Toby and I host very large events. You don't have to necessarily do that, right? You can go to events, you can host small meetups, whatever, or you host meetups in your city, but you have to get out there and build community, build connection, bring value, right? If you're not gonna do that, and let's say you're not an extroverted person, then you have to build it on social media. You have to put out content every day. You have to build up your Twitter, build up your LinkedIn. And so again, when I meet founders, and if they're not doing either, and they're complaining about fundraising, I have no sympathy, zero. Because you have to do in this day and age, like what you're doing right now, you're doing podcasts, you're on socials, you have to do one of those too.
Yeah. I think for me as a founder, I think you have to do everything, to be honest. You need to be, it's my experience.
Well, really, you're supposed to be doing both. Yeah.
You need to do branding, your personal brand, social media, go out, talk to people, do network, throw your story out there, whatever it is. Some people will like, someone will not like. At least my journey has been like that. Some people has been tremendously supportive from day one. Some people were like, well, we'll wait and see what's happening. And then they came in last year I started, there were people who rejected to give small checks that time. And after 4 months, 5 months, they came back and gave me the check. So I know it's a painful, consuming process, but this is how it works. You are asking someone else money, so it has to be painful, I guess. Anyways, moving on to the next question is, okay, great. I think, a lot of VCs will say this, we don't have a particular thesis, we will look into, project by project. But I think what you shared is still very valuable for any founder to understand, if they are at early stage, what all things they need to do or think. If they have already raised funds, what all things they need to do or think. Now, one last question is regarding valuation, right? So there's always a tussle between founder and VCs or investor on the valuation. A lot of time it is about, some projects are overvalued, $100 million valuation, token launches are happening. Some founders who are new and who doesn't know much of the game, they sell undervalue. The question to you is, how does VC care, like if you are overvalued or undervalued? If a founder valuation is undervalued, does VCs look that as an opportunity, or maybe like, oh, this founder is not that experienced, that way the valuation is not that great, he's selling the company at very low? Is that the perception? Or when it goes beyond a high valuation, then your guys are like, oh, this is extremely expensive, let's just stay away from it. What's the VC mindset regarding this?
Okay, this is another long topic. Okay, so first, what I'll say is, it depends what part of the world you're talking about, right? At my prior fund, we invested all over Latin America, Middle East, Southeast Asia, India, Africa, Europe. That ranges like big time. Like a $10 million round, a $10 million valuation in America for a pre-seed is normal. Like raising 1 on 10 is very normal.
Yeah.
Other parts of the world, that's like high. Right. So like the first question is like, what part of the world are you in? Are you raising from? So if we're just saying like America as an example, then yeah, raising 1.5 on 10, like for your very first round. But it's also very subjective based on the founder background, right? Like if you've never raised before and you don't have a strong VC network, yeah, your valuation is not going to be high. I mean, I get this very often in founder meetings where they're like, hey, I saw this other company raised all this money, and they like haven't even launched a product. And like my company, like we have $1 million ARR and they raise more than us, right? And my response is always, yeah, but you don't have their investor network, obviously, right? Like it doesn't mean, and the other thing is like why the valuation topic kind of drives me nuts a little bit is like, it doesn't really matter, right? Like who cares if you raise it a 20, a 10, or eventually a 30 or more, right? As you like start to like grow your company. The biggest thing to worry about or to focus on is dilution, right? That's like the biggest myth that founders do, where I've seen them raise it like a 5 cap and they raise like 1.5 million and they have like 2 advisors come on board and they give them a bunch of equity. And it's like before they even get to their seed round, they've given up 25% of their round. They're 25% equity in their company. And I'm like, as an investor, that alone, you couldn't even tell me anything else about that company. I'd probably 99.99% chance, doesn't matter. Unless it was like Elon Musk or something, I wouldn't even look at that deal, because when you start to do the math, you have to raise quite a bit of money. You're going to dilute yourself so much. You're not going to be motivated because you're not going to own enough in the business. And like, if I can't see a founder being motivated because they don't have enough equity over time, then this company's going to go nowhere, right? And that's like the flip side of founders that during the peak ZERP that raised $10 million, like a 90 cap as a seed round. Those same founders have a really tough time now, because raising a seed round at a 90 cap and then trying to raise in this market, forget it. You're going to raise at way lower valuation. That's when I tell founders when they see their friends, they see someone, this person like raised more money than me. I'm like, yeah, when you raise at a high valuation, you have to fill into those shoes. And doesn't mean that they're doing better than you. It just means, yeah, they raise more money, but that doesn't mean that they're doing so better. So it's like, yeah, don't overthink other people raising more money to you. Focus on how much dilution you're giving up per round, which generally should be 10 to 15%, 20%, above as you get maybe Series A and beyond for much larger rounds. But as long as you're in that window, it doesn't really matter what your valuation. You can raise technically at a 5 cap and raise 500K and then bump your cap. But where founders get in trouble is they raise at a 10 cap and they raise like 3 million. And it's like, well, now you're screwed, because now you just give up 30% of your company on your very first round of funding. And then founders feel pressure because they go, okay, I raised 1.5 at 10, but then I had this other guy come in and go, oh, I'll give you $1 million, but I want to come in at 10.
Yeah.
And you have to have the stones to turn that person down and be like, look, I would love for you to come on board. I'd love for you on the cap table. I have to bump it to 15 because my dilution's already at 15%. If I bring you on, I'm now at 25%. You don't want me to be not motivated over time. You don't want me to take this big dilution hit, or let me give you, $250K at this lower one and the rest at a higher. Like that's is where, and then some founders you come from a point of desperation. You just take that money, and yeah, maybe in the short term it works, but when you go to the next round and you want to talk to like leads like us, and I look at your cap table and I'm like, you're gonna give up 30% of your company, and I need like 8 to 10% of your company. So you're gonna give up 50% before you even get past your seed round.
Yeah. Interesting. So one last question before we conclude, because we are very close to 45 minutes, is, this is a whole summary. We touched point on a lot of things that will be very crucial and helpful to the founders. But if you have to summarize, 4 or 5 very important points who are building or who are started to build this market, which is confusing. God knows whether it is bear or bull. does it even matter for a founder to think about bear and bull is also a question, at least for me. Like, if you're a founder, you're a builder, if it has value, you will be committed to it. But whatever it is, if you have to give like 4 or 5 very important takeaways that you would like to share the founders who are building now, what would be that?
Yeah, there's definitely a lot of points I could say, but to keep it short, one, hope for the best and prepare for the worst. So when that comes to raising money, prepare for the worst, meaning it may take you twice as long as you expect, especially with elections coming up. A lot of people are going to be holding their wallets. I know this because when you're raising a fund, LPs are the same. They want to kind of wait and see how elections go, right? So just prepare for that. Start building your network today, not tomorrow, today. So if you haven't been posting on socials, do that. If you haven't been going to events, you need to do that. You have to start somewhere to build your network of investors. 3, be very honest about the strengths and weaknesses of yourself and your team. And so if you need to bring someone on, and a lot of founders bang their head against the wall for many years because they think, oh, I'm the sales guy and I'm the tech guy and I'm the product guy. And it's like, you're probably not. You're probably not the unicorn person. I'm not. I mean, I meet a lot of founders. It's very rare, and there's no ego around that. It's just, look, drop the ego and bring someone on that can help that. And maybe that person can lead. I've met founders where the COO is the one doing all the fundraising, and that's normal. And that's many companies like that. And then lastly is, as you scale and you actually raise your round, however long you think your runway is, always give yourself another 6 months of leeway. Because whenever I read their projections, I'm always like, yeah, you're way too optimistic. And I much more believe founders that are pessimistic. On the call, you can be optimistic about where you're going, but on your numbers, be pessimistic.
Yeah, absolutely. That helps. Always be ready for the worst case scenario and keep thinking about plan B, C, D, E, whatever it is. I think that's very important for being a founder. Cool. Thank you, Brent. I think, we are on time, and I would love to preserve the time and make it efficient. So, but even though like last 30, 45 minutes were really helpful, just so that, even for me, I learned so many things. Just hearing what the perspective goes on an investor mind, because a founder is a founder. They want a lot of things. Investor, they're putting money. They have different pressures. So it's always great to know and learn how they think, how they do decisions. Because a lot of new founders, a lot of first-time founders, they have no idea how it works. And so I always keep saying, like, fundraising is not hard. There is a secret key that most first-time founders, they don't know, and that's why they keep struggling. So thank you so much for this time, and I really appreciate you sharing. And I'm pretty sure the audience who are going to listen to this, they will be benefited from this.
Absolutely. Thank you for having me. You asked a lot of really good questions, and always happy to come on. And Godspeed to all the founders out there raising capital in this market.